What's up, guys? How are you doing today? A little bit of market news today, of course. Market are down pretty big right now. Let me adjust my microphone here. Um, Happy to talk to anyone pretty much about any subject today. Did want to address the markets and kind of why markets are down today. Number of different explanations for that. The Fed raised interest rates by half a point, generally seen as a positive sign, meaning they're kind of taking the brakes off of raising interest rates for a little while. I expected the markets to act positively towards that. They really didn't, and that was because the Federal Reserve pretty much laid out the future of interest rates with their so-called dot plot, where basically they described interest rates, the terminal rate at being somewhere north of 5%. So at least at a bare minimum, three more interest rate raises at a quarter of a percent. No drop in interest rates for the next year. So all of 23 out of them. So not beyond expectations for me. And I think that the Federal Reserve has been setting the stage for this for quite some time. And so it shouldn't have been a surprise to markets, but I think it kind of has been. So market was down as much as 900 points when I looked at earlier today. It looks like the Dow is going to be down about 763. The S&P down about 99 points. So the chances of the S&P ending up at the most optimistic forecast that I saw around 4,200 this year, I don't think that's going to happen. I thought there was a chance it might happen. It looks like we may not have our traditional annual Santa Claus rally. Additional bad news hit the market today. Retail sales down by about 0.6% month over month. I'm sorry, annually, which is about a 0.5% more than was expected. It didn't look like that the record Black Friday and Cyber Monday sales were able to help out at all. But I think the big news has nothing to do with that. It has everything to do with something that folks on this channel probably don't pay that much attention to, and that is the Bank of England and the European Central Bank raising rates. And are they doing that because the United States is doing that? Yes and no. They have a different priority when it comes to fighting inflation. Certainly their largest concern. That is the only, for the European Central Bank and for the Bank of England, that is essentially their only role, is to control inflation. But really what it's about right now is yields on longer term government debt. So they have to raise interest rates because U.S. interest rates are so high at this point that we are attracting all of the investment. Despite the fact that short-term yields now are between 4 and 4.5%, long-term debt, I mean, the yield curve is still inverted, and long-term debt for the United States, the 10-year is at 3.452, and the 30-year is at 3.499. So once you get beyond real short maturities, that interest rate curve is relatively flat, and it's higher than most other developed markets. Even those developed markets that have relatively stable economies are seen as a greater default risk, at least theoretically, than the United States is. That's a country that's never failed to pay on its bond obligations. So they were basically forced to raise interest rates in order to keep yields, in order to support bond prices. So that's one of the things. I mean, yields would have been up anyway because demand would have dropped on their bonds as more and more money fled to the United States. The dollar would have become even stronger and stronger, which is not necessarily something we want. This is actually kind of positive. This is the silver lining that I've talked about in the title of this, is that with the European Central Bank and the Bank of England also raising interest rates, it's going to moderate the strengthening of the dollar. It is going to possibly hurt agricultural sales overseas, but it's going to help for everything else that we export, meaning that our products are not going to be getting quite as expensive quite so fast overseas. So Redshift makes the statement that UK inflation is about 10%, I think. And yeah, so our inflation has dipped to right around 7% or so. Our energy markets are probably a large part of that. Particularly our natural gas prices on this side of the Atlantic are a lot less expensive. largely because of how localized natural gas markets have been in the last half century or so. It's not an internationalized market like oil is. So, and I find that there's a surprising lack of knowledge when it comes to how energy markets work worldwide in the United States. And I don't think, to me, this is not a surprise that inflation is a little bit higher, and it's largely based on energy prices. Uh, Also, we're reaching a point, and I kind of am slow to be convinced of a lot of large groundbreaking changes in the economy. But one of the things I am convinced of at this point is that globalization is reversing course. It doesn't mean that we're going to be producing, cheap plastic items here in the United States. That's still going to be produced overseas, but it means that globalization is reversing course to a degree. And also, what we do get overseas is likely to be diversified in the future as manufacturing of certain items has started to move outside of China. And I'm talking about textiles, finished clothing, plastic goods, that sort of thing. Bangladesh, India, Indonesia, Malaysia, and a lot of other countries are the primary beneficiaries of that. A lot of that has to do with how expensive labor has become in China. We've seen a 15x increase in the cost of labor since the 1980s, and now there are cheaper labor markets all around. So one of the things that I addressed in a post that I made on the channel yesterday was, what are the effects of the Saudis thinking about or beginning to accept contracts in yuan? Is it going to end the petrodollar? So my opinion on this, and it is just an opinion, is that the Saudis are probably not going to do away with the petrodollar, but they're going to accept yuan denominated contracts in addition to dollar denominated contracts. I actually think that this is probably going to end up backfiring on the Kingdom of Saudi Arabia. What they got in this case is pretty much a guarantee now that the Chinese are going to devalue the yuan. So one of the issues that the China has been having to deal with now for the last 40 years or so is that most of the issues of bonds they have are not denominated in yuan, they're denominated in dollars. So they are subject to the whims and vagaries of the market. And to counter that, they have really strictly controlled the money supply in their country, a lot like we do, but they've strictly controlled how it floats on the international markets to a degree. So that is going to come to an end, and here's why. Having contracts denominated in yuan is going to basically force the rest of the world to start keeping yuan in foreign reserve, banks, in countries' foreign reserves, in sovereign wealth funds, and all of that sort of thing. It's also going to increase the demand for Chinese bonds in lieu of currency, which is one of the things that happens. Man, why do people keep advertising porn here? I don't get it. They never even put the link in there, but it's always there. So let me go ahead and get rid of this person. But because that's going to increase the demand for Chinese currency overseas to be put into foreign reserves, for the amount of bonds sold on the open market. Like, one of the ways that people shore up their own currency worldwide is to buy U.S. bonds because of their stable value. The same thing is going to happen with China. Now, China, when that starts to happen, when that becomes a big deal, they're suddenly going to have a major advantage when it comes to financing internal expansion. So because of their property crisis right now and their private debt crisis, they're likely going to see a pretty large public bailout. And I'm sure it's not going to be a bloodless bailout. There are going to be heads that roll in the property industry, but there is going to be a large public bailout of a private debt. It's going to be replaced by debt that's issued by the central government or by local governments. It's going to be denominated in yuan. That's going to give the Chinese government the opportunity to let their currency depreciate over time, much like the United States does. They're going to be borrowing money, paying interest on it, and paying you back eventually with depreciated currency down the road. So our target inflation rate of 2% means that by the time a 30-year bond comes to maturity, we're paying you back with vastly depreciated dollars. Now, most institutions and people don't buy a 30-year bond and then keep it around for 30 years. They buy and sell those bonds. They create portfolios with durations of 7 to 14 years, rather than 30 years. And well, there's no bond with a duration of 30 years. Duration is a very specific term that I'm not going to get into here, but this offers the Chinese government the opportunity to pay back bonds with depreciated currency. They didn't have that ability before because they had to pay it back in US dollars for the most part. So that's one of the things that's going to change. It's going to be a very large advantage to China in terms of financing this restructuring of their economy. It's also going to help out exporters as well when they go to borrow from banks or go to issue bonds in order to finance export operations. And that's actually going to help their efficiency and help sort of offset the increased cost of labor. The Chinese economy, in order to compete with the rest of the world, they need to radically restructure their economy in order to get more in the way of productivity. They're really a low productivity superpower. Their productivity is pretty much at the same level the United States' productivity was in the 1950s, meaning their workers are just about as productive as ours were in the 1950s in terms of GDP produced per capita. So because they're dealing with a declining population and rising cost of labor, their productivity increases need to increase faster than their population is declining and the cost of labor rises. And this is one of the fundamental things they have to change about finance in order to fund that transformation of their society. This is going to be a difficult thing to do. It's going to be an unpredictable thing to do. It's not an insurmountable problem, but at least I don't think it is. But it's a problem that no society in history has ever had to deal with at this scale in this type of environment. What normally would have happened in history, if you face a declining society and rising debt and that sort of thing, what you usually get is invaded by barbarians and taken over, right? The era of that happening is over to a degree. So what happens next is kind of up in the air. There are alternating versions. You can take the Peter Zeihan approach for what China is going to look like, or you can take the Ray Dalio approach for what China is going to look like. I lean more towards Peter Zeihan just because of the demographic issue. So, do you think it's a good idea for the Fed to keep raising interest rates? So, I'm not the person who's going to lose my job because interest rates go up. That's not going to happen to me because of diversified business interests. All my businesses would have to go out of business at the same time. So I'm looking at this kind of at a cold, bloodless way. I think it's a fantastic idea for the Fed to keep raising interest rates in order to kill long-term inflation. I don't think we're going to get back to 2% inflation anytime soon. I think it's going to be elevated. I think inflation has averaged about 2.34% over the 30 years prior to 2020. I don't think we're going to get back to that. I think that inflation is going to be closer to 3% or a little bit over, and it's going to stay that way pretty much for a generation. Some of the things that China is going to be forced to do in order to modernize their economy, we're going to have to do too. We're going to have to change the way we source natural resources. We're going to have to change the way we manufacture. We're going to change the way investment works as well because of the increased cost of capital in this environment. And that's going to continue for years. It doesn't mean the economy is not going to grow. It doesn't mean there's not going to be plenty of investment opportunity out there. It's just that the economy is going to be radically different over the next 10 years than it has been over the last 10 years. And this is nothing new either, guys. This is always the case. Anytime we have an economic crisis of any sort, the economy never goes back to what it was before. It becomes something new. And staying ahead of that curve, or at least riding that wave, is what is likely to happen. Hold on a second. Ug also says, is it possible to have inflation go down as the world decouples? I doubt that's going to be true. And a lot of it has to do with public investment in the future of the economy. I think that China just committed something like $180 billion to their chip industry. We just committed like $50 billion to the chip industry. You can look for both of those things both of those investments to rise quite a bit, especially the investment the United States is making is going to rise quite a bit over the next couple of years. It appears that the United States is basically trying to steal TSMC, or Taiwan Semiconductor Manufacturing Corporation, from Taiwan. They're making a really good case that this is a great thing for risk mitigation, and for a number of different reasons. The possibility that China attempts to invade Taiwan is not zero. I think that it's not very high, but I think it's not zero. And I think that's been reinforced by the difficulty that Russia has had taking Ukraine, particularly taking it intact. I think they look at Taiwan as possibly being just as hard a nut to crack there because of the logistics involved and getting, an army across the ocean, the open ocean, defended by, to an island that's defended by the United States and the Taiwanese military, which is no slouch. And the fact that the Taiwanese military has decided to invest a lot more money into development of defense. But yeah, Michael Will says, do you think that the S&P 500 will drop to 3,600 again, or possibly down to 30? I think that 3,600 is probably going to be the bottom. And a lot of this has to do with looking at past recessions. And I don't view this recession that we are likely to go through as being fundamentally different than any of the normal sort of cyclical recessions that we've gone through since World War II. This is not a 2008 moment. This is, sort of like a 2001 moment where we had a dot-com crash, where we had certain industries that had formed bubbles. And these bubbles are being popped by the increased cost of capital right now. And it's popped a hole basically in sort of the irrational exuberance that we had versus tech. So I still think that we have every bit of possibility when it comes to tech that we had prior to this happening. It's just that it was mispriced. It's just that our expectations for the timeline and the multiples behind what is, what's going to happen with tech stocks, I think that's the bubble that's been popped. But do I think there's not going to be a genomic revolution? No, I don't think that. It's actually still going on right now. If you're looking at the research that's being done right now in individual gene-based treatments, it's amazing. If you think that that next generation internet is not going to be a thing, you're wrong about that. If you think electric vehicles are not going to be a thing, you're wrong about that. Yeah. Let me see here. And do you think there's still more pain to come in 2023? I think that first half of 2023 is likely to see more volatility, meaning that we bounce around between 3,600 and 4,000 a few more times before the market starts to catch fire. So before the Federal Reserve decides to stop raising interest rates, we're going to see the market turn around. Before anyone says, oh, this recession is over, you're going to see the market turn around. That's essentially what always happens is once the economy starts growing and the evidence comes in, and it's usually a month late when the evidence comes in that the economy is growing, the market has already figured that out and is priced in market rallies in the future. So the stock market's a forward pricing mechanism. And that's one of the things that a lot of newer investors don't do is they're focused right now on current pain, not necessarily realizing that market is really a forward pricing mechanism. So first half of 2023, I expect pain, but I expect elation too, meaning we're going to have really strong up days and really strong bound days. You're going to get your hopes up numerous amounts of times, and then it's going to be dashed by market volatility. That's kind of where we are right now. And it's really when the bond market decides that the recession is over, that's when the recession is actually over. And it's when we see global yields normalize here, meaning that short-term interest rates, once they get significantly lower than long-term interest rates, that's when we probably see the stock market turn around. Right now, we have a federal funds rate at 4.5% and a 10-year treasury at 3.4. So this is a market where you're fighting the Fed if you're really betting on, on like huge short-term rallies or and the Fed's not going to cut interest rates anytime soon. That's what they've made clear. They view inflation as being a very long-term fight. So, if you're looking at the only real bright spot out there in terms of Japan, and I have actually relatives visiting from Japan this month, the relatives by marriage. I'm not Japanese. But the only bright spot in terms of a bond market right now is Japan, where a 5-year treasury yields 0.13%, a 10-year yields 0.256, and a 30-year Japanese treasury earns 1.433. I think this may be the only sort of market in all of the world where interest rates are not, or the yield curve isn't inverted. Although I haven't seen short-term interest rates in Japan recently, so. Let me see here. I have a number of UK EU junior miners on my watch list, mostly bottomed out and have formed a base over the last few months. However, they've broken that resistance since Fed announcements. Yeah, that's just because there's no such thing really as a base or a bottom. And even when I talk about, I think that the S&P 500 has reached a bottom, there isn't a bottom. The bottom is zero and total collapse of the economy, right? So, but the likelihood of that happening is fairly low. So I've seen over and over and over the predictions of the S&P bottoming out about 3,200. The mathematical case there, it isn't really there. And this is actually especially aided by sort of the crash in crypto and what's happening right now is a lot of the funds that would have flown normally into the stock market during COVID. It actually went into crypto in that time period, and that money has basically evaporated. And when I say evaporated, meaning it's not coming back. These were money that was on electronic entries. It evaporated into the ether because of how little in the way of derivatives were actually traded on this. There aren't as many derivatives traded on crypto as people might think. So if you had, bought, and in fact, I remember right before I was going to open up a business 2 years ago, my business partner was like, "Hey man, I'm just going to stick all my money in crypto. And like 2 months from now, I'll be 25% up." And it was literally like right at the height of crypto, right when Bitcoin was at like 63,000 or 65,000 or something like that. I'm like, "Hey dude, that's kind of a really bad idea." If you're going to invest in crypto at this point, I think it's going to be a long-term investment since we've seen this giant run up and we don't have a lot of use cases for it right now. Volatility continues until it becomes essentially something that's used regularly by the general junior miners. So especially with junior miners, you're talking about people actually mining resources. Remember how these mining companies are set up. They're set up in a lot of ways like Wildcat oil companies are in the United States, where you have people that leave a larger company. They end up getting private equity funding or private investments from people at that old company to open up a new mining company to go explore a lease. And there's a lot of risk involved with that, right? When we're talking about these companies bottoming out, the way they form these companies is to limit liability because so many of them fail. And that's one of the things you're going to see in the lithium industry pretty hardcore over the next 10 years. You're going to see a number of players really separate themselves. I don't know how many there are, but you're going to see a number of players really separate themselves in lithium mining, and they're going to be very, very wealthy in the future. But the vast majority of these miners that are getting into this business, meaning a lot of them are trying new mining techniques, a lot of them are trying new refining techniques, all kinds of things, and a lot of it's just not going to be commercially viable, right? And the companies are going to fail. And and their charts look flat. Their charts look flat because they don't make it big until they start really producing at scale. And most of these miners aren't going to produce at scale in a manner that's cost efficient. Right now, you're just based on your economies of scale when it comes to lithium mining. It's not that lithium mining is rare. Lithium's everywhere. It's just locked up in various chemical forms because lithium does not occur in its unbonded format. It's too reactive. I mean, if it hits open air, it's going to react with something and bond with it. So a lot of times you're looking at like lithium salts, like brine fields or something like that, or salt flats. That's where you're going to find it. There's lots of lithium in the open ocean that could be mined. We have our issues with mining from the open ocean, largely because of the energy costs for that. But lithium that's being provided right now uses maybe 4 or 5 different methods of mining and refining, and none of them are particularly efficient. And it's largely because we just haven't been doing it at scale for very long. Like really the first lithium batteries were described in government literature sometime in the late 1960s. It was like 1980s, I think 83 or 84, when some government funded academic research came out that really showed how to go forward with cheaply produced lithium ion batteries. But the cost of lithium ion batteries did not drop below the cost of any other chemistry, really any other like prominent chemistry, until 2005. So the demand wasn't really there until 2005 to put a lot of energy into. So there's a lot of energy that's been put into different lithium ion battery chemistries. Not a lot of energy or innovation yet put into how the material is going to be mined and refined. And that's what is going to be very difficult to predict, is what new techniques for lithium mining, lithium refining are actually going to be commercially viable. And I think that's the biggest threat to an investment portfolio. And much like we saw with the early auto industry, the early computer industry, the early genomic, wave that came out, like say, like 2005 timeframe, laptop computer, not laptop computers, but desktop computers in the early 1990s. You're going to have lots and lots and lots of different companies and just a few survivors. And for that reason, I would probably avoid investing in junior miners. And if you really want to invest in junior miners because you're looking to hit that home run, I'd still do it in the form of an ETF. I think it would be impossible to predict. And it's very easy mainly because I invest in the oil industry for so long. I know how these investment packages are put together. I know how the propaganda is used to get people to invest. And it's actually extremely seductive. So I've invested in dozens of different wildcatting operations. 3 have been successful. The rest of them have all failed. When I say 3 have been successful, 2 of them have produced meh returns, and only one of them has really been good. So yeah, we see here. Don sees your Shadim. Finally able to catch this awesome live stream. Been listening to you for about a month as I try and reinvent myself from a YOLOing meme stock degenerate to an actual investor. I learn a lot from you. Thank you. It's always nice to get new subscribers on my channel. And if you haven't subscribed, please do so. Largely because there are a few YouTubers that I really like out there. In the Money is one of those. But I actually don't say a lot of things about other YouTubers because a lot of what I would have to say is kind of negative. And I mean, that's literally, I would have to say a lot of negative things about them because that's kind of all they do is say you should be YOLOing this or YOLOing that. So I'm an actual certified financial planner. I cannot recommend a stock or any sort of security on this channel at all without getting in trouble with, with not the SEC, but with FINRA. So what I give is more generalized investing advice. What we talk about is more generalized trends in stock market and the economy. And I'm always going to answer questions when it comes to individual stocks if I can. If I don't know anything about it, I usually tell you that I really don't know much about the stock or something like that. And we'll look at the basic numbers and I'll kind of give you my opinion on there, but it's never a recommendation to buy or sell any security. So YOLO investing, look, guys, it's fun. I've always got a few YOLOs in my stock portfolio. One of those right now is MoneyLion. I bought a butt ton of shares for very little money. I put about $20,000 in there. Look, if it goes up to like $45 a share in the next 10 years, it's going to make a lot of money for me. But there's a good chance that I could lose all 20,000 of that. Despite the fact that it's a company that keeps growing. It is a company that has a pretty good, decent plan. Marketing plan and business plan. It also has a marketing education plan, which I'll fully admit that I don't really understand because it's largely aimed at a generation, 2 generations below me. It's really sort of a Gen Z platform for finances. But I'm not promoting that you go use this. I'm not promoting that you buy the stock. I'm stating that I YOLO it. So I will say there is one stock that I'm probably looking at buying that is another speculative risk. One though that I have enjoyed their products. I like their services, and there's some opportunity there too, just because the price is very low. But let's talk about how price being low doesn't necessarily mean that much. And what I'm talking about is UI The symbol Peach. I don't own stock right now. I'm not being paid to promote it or anything like that. But this is a company with a market cap of about 7.24 billion, which, to be honest with you, based on the revenues, I think that's a pretty high market cap. So it's still overvalued in my opinion. But also, of course, they're overvalued. Right now, they're trading at negative 76 cents per share. And their last earnings date was on December 1st. Their earnings actually look pretty good. And if we look at earnings over the last 4 quarters, they have consistently beat estimates, even though they've been radically cutting guidance in that time period, which has probably affected their stock price. They're down from about $45 a share to roughly $12 a share today. And the guidance has kind of returned from the last 4 quarters back up to like 6 cents a share in profit. So they had basically positive. Their estimate was 3. They still had positive earnings here. They had positive earnings here when they were expecting negative earnings, positive earnings here when they were expecting negative earnings, and positive earnings in the last. So the last 4 quarters have been positive here in terms of earnings. When we're looking at annual revenues are growing, but their costs are growing as well. I don't know whether or not they've announced layoffs or anything like that, but that is probably what we are looking at here in the future. I think I stated this on the last live stream. I think a lot of companies are going to be using what's going on now as an excuse to dump 10-15% of their workforce no matter what. I told you that I was involved in the IT industry for a long time in software development. And I told my bosses this numerous times that I could cut 10, 15, 20% of my workforce at any point, and there would be zero impact to productivity because certain people at certain times just aren't productive when it comes to programming. There's a high burnout factor. There's a high boredom factor. And the fact is a lot of people just suck at software development. Even though they know how to code, they can't do it creatively enough and fast enough to get products to market without tons of errors, right? Now, a lot has changed in the industry since I was an active software developer. There are a lot more tools to help with productivity. But I would imagine that you cannot, the same thing was true back then is probably true now. You cannot educate people into creativity. It just doesn't happen. And that's required in the software industry. And so layoffs, when given the opportunity to do it with as little negative PR as possible, that's what companies are doing right now. This is a time when people expect layoffs. So they're kind of preemptively laying off some of their lowest productive workers. So, but UiPath has not announced, as far as I know, any of this, but they automate business processes. This is not a sexy company, but this is a company that I think has the potential to be a long-term winner. There's no bottom here, right? In terms of this company, they are not making money right now. The last 4 quarters, they've been profitable, but when it comes to like year-end accountancy, I actually don't expect that. So, let me see. The VIX seems low. Can you define what it considers volatility? So the VIX is a measure of like consumer fear. When I say volatility, I'm really looking at the deviation of stock market returns around the mean return, right? So right now, I would say that actually, I don't know. I'd have to go back and look. But I would say that the deviation off of the daily mean return of the stock market, an up market and a down market, I'd say that we're at a period where a lot more volatile than we have been in the past. The 2% swings in the market right now that we're seeing, the 2.25% swings in the market, generally when the market is going up or down and people don't have a great deal of fear, that swing is limited to like 1.25%. The fact it's like 2.5%, we've seen a couple 4% days in the last year or so. I would say that that's a better indicator of volatility. The VIX, I've never particularly liked that sort of measurement of stock market volatility because of how the surveys are conducted. So, yep, you see here. Luke says, I generally stay away from loss-making companies, but SoFi and MoneyLion are 2 interesting stocks that I can't add to my portfolio because of that. Now, and I totally get that. MoneyLion, like I said, is a much more speculative risk. SoFi, on the other hand, is further on the path to not necessarily towards profitability, but further on the path towards really solid. They have a much more lucrative footprint in financial services and in technology services. And the technology services part of SoFi really doesn't get a lot of press. It's not profitable at this point, but the growth in that sector is really strong. And the best thing about the growth in that sector is that they're providing like back-end functionality for other fintech companies to have access to the financial world. So this is a very sticky relationship. It's very difficult to go to from your one company providing credit card issuing services to switch to another one. Very difficult to realign your systems to do that seamlessly without great cost. So once once Galileo, which is now a part of SoFi, gets your credit card business, or gets your buy now pay later business, or gets your banking business, you aren't going to leave unless there's a massively better option at a much lower price point, because the difficulty and the issues that it would cost to switch are going to be it would be very cost prohibitive. So I would not be surprised if with very quickly if we see that financial services, the technology arm, and their lending products all pretty much have an equal share of that revenue pie. And I think that has been, well, I don't think, I know that has been accelerated by the moratorium on student loans. The student loan business basically has been dead for 2 years, or 2 years at this point. And SoFi has been able to move on, create new income streams, and grow those new income streams without that student loan business coming back. And when I say it's been dead, it's been down by like 86% since February of 2020. It's been absolutely dead, and they have been able to increase their business pretty much in line with expectations. They have lowered guidance, and when they did it, they lowered guidance by like $10 million back in June, and it looks like they're going to beat that lower guidance and pretty much hit their full year guidance that they originally put out at the beginning of 2022. So, am I happy about the stock price? Not happy about the stock price. Am I happy about the fact that they're executing on their vision? Absolutely happy with the fact that they're executing on their vision. Are you still bullish on banks? Yeah, absolutely happy with banks with interest rates rising. There are so many opportunities for banks with interest rates rising that have not been there because of how low interest rates have been. Also, there's going to be a benefit to consumers as well coming out of the high interest rate environment. Let me put it to you this way, though. If you have a mortgage at like 2.35% that you got on the VA loan or something like that, or 2.15% is kind of one of the lowest VA loans I've ever seen, at least on paper, you should never refi. And you should be careful about buying a new place if you're going to sell your old one, because you're never going to see those interest rates again in your lifetime. If you're my age, if you're in your 40s, you're never going to see those interest rates again. I think the interest rates are always going to be higher than they were in the last 8 to 10 years or so. And a lot of that has to do with the fact that the Fed really backed themselves into a corner in 2008, and they didn't have the sort of ammunition in their magazine when it came to 2022, and they had to invent new tools in order to create liquidity. And they had to really overuse the tool of buying government securities on the open market and bloating their balance sheet. And I think that that is one of the things they're looking to avoid for the next crisis, meaning it will not require the next crisis that we have, whether that's 5, 7, 10 years from now, is hopefully not going to require as much creativity to create liquidity, because we're going to have a normalized interest rate regime where short-term interest rates would be at 3%, long-term interest rates would be at 5 to 7% for like 30-year bonds or mortgages or something like that. So it would be a lot easier to stimulate the economy just using the really blunt tool like the sledgehammer that raising interest rates is. The other thing is, the Federal Reserve is probably in the future going to bring back hard and fast reserve requirements for banks. That is another one of those things that disappeared in this crisis, is that the reserve requirements for banks were really loosened up. And number one, I think it's a risk to have for banks. But number two, I think that's another tool they would like to bring back in their quiver, meaning that if you want to suck money out of the economy next time, instead of raising interest rates and taking the blame for that, you can let the market do that by raising deposit requirements at banks. Like, let's say that the deposit requirement for banks right now is 6%. I don't know what it actually is, but I think it's 6%. So for every dollar that a bank has on deposit, they generally have about, from customers, they generally only keep about $6 of that. They lend the rest of the money out. And that $6 is there for like runs on the bank, which we all know they're not going to survive in the case of a run on the bank. They're going to have to be bailed out by the Federal Reserve. If you really want to suck money out of the economy, you just go to all the banks and say, now the Federal Reserve, if you want to do business with the Federal Reserve and be able to take out overnight loans, your reserve requirements are now 7%. Every percentage point on that essentially sucks out somewhere between 8 and 10% of the money out of the economy, like instantly overnight in the form of an electronic entry. Okay. So the Federal Reserve right now doesn't have that tool. So let me see here. Oh, this is a good question about a 3D printing stock. Let me start saying that I'm completely and totally biased against 3D printing stocks. It's not that I don't like 3D printing. I think it's an amazing technology. I think that it's going to change the world one day. But once again, picking a winner for this industry is going to be extremely difficult. Let me first state off that I was one of the early investors in the first wave of, so I don't know what's happening here. I was one of the early investors in the first wave of 3D printing companies that came out, and I lost a lot of money on 3D printing. At one point, I think I think I had the highest purchase on this DDD, that 3D printing company. I think I pretty much had the highest purchase ever on that stock. I bought it for like 99.14 or something like that. Ended up selling it around like 50 or something. It may have even been worse than that. I may be making it look better in my mind because I don't want to admit how much I lost on that. But I've kept my eye on these stocks for a very, very long time. And the problem with all of these is none of these companies have ever even been close to profitability, right? At least sustained profitability. A few of them had like a few months here and there. So Desktop Metals traded on New York Stock Exchange, getting dangerously close at $1.48 right now to the point where they'd get a delisting letter and they would be forced to make a decision if they couldn't bring the price back up over $1. They'd be forced to make that decision in that 6-month period as to whether or not they're going to leave the exchange, which is not likely, or do a reverse merger. So volume is healthy on this stock, but not that many shares trade hands every day, about 5.7 million. About 90 cents per share loss, and monthly beta is only 0.29, right? So it is not a highly volatile stock in relation to the other market. And probably because, like I said, volume is fairly healthy on this stock. But when I'm looking at year-to-date trading on this, it's actually busted out of its range pretty high here. But over the last, wonder what their 5-year monthly beta. Well, that makes a lot of sense. It was flat for a very long time. For a very long time, and it's declined since January 1st, 2021. But it looks like, I don't know if it was flat. Yeah, it was really flat for a very long time. So that's probably affecting the beta. Anytime, a lot of times I don't have to look back that far in order to see why beta is so low. But this is a 5-year beta number. There aren't 5 years in. There aren't 5 years in the thing here. They've all been publicly traded since June 1st of 2019, and for a large part of that, the stock was completely flat. So they didn't have a lot of earnings, that's for sure. They've got under $100 million in earnings. If you got under $100 million in earnings, a market cap of $470 million, you've missed earnings for 3 out of the last 4 quarters, just barely met earnings. None of those earnings were expected to be above water. You're losing twice as much money as you're bringing in revenue right now. I would say that drop is perfectly justified, and I would say that there isn't a bottom for this stock. I'm not saying they won't be successful in the future, but in terms of the hard numbers and current cash flow, there is it would be impossible to give this a value above 0 that I can justify with numbers. Even if I said they sold all their equipment and all their patents, I don't know, but we'd have to see. So This is still a young company, though. This could be a really good entry point, but I don't know enough about the company's particular projects. But I will say one thing: the last, really new 3D printing company that I investigated was, of course, Nano Dimensions, and there was so much hype surrounding it. And when I looked at what they were actually doing, what their business strategy was, I was like, oh, this is basically HP for 3D printing, where they're going to sell you the ink. They're selling you the printer for not too much higher above cost right now, but they're really going to make money by selling you the ink. And the problem is that you could, all of these companies now are making their own 3D printing things that can do printed circuit boards. By the time I had researched that, there were already 4 competitors. I bet there's more now, and they all have their own patented dielectric ink that you can only buy from them, and it only works in that machine. So just like we saw the printing industry sort of consolidate to where now nobody has a printer they like, that may be what happens with the 3D printing industry. Although I imagine that being a more demanding technology, there's going to be being a more demanding technology is going to be a higher degree of quality in there. But there are a couple of other exciting things when it comes to with Desktop Metal, which is really their manufacturing system for metal parts, which could be revolutionary. But I got to see, man, I've gotten burned so many times on 3D printing stocks. I really got to see results before I get excited about this. Hold a second here. Come on, we all want to know, are you getting the F-150 Lightning, the Cybertruck, or the Rivian to tow your boat? So the only boat I have right now is one that I built, although I'm probably building another one this summer. I'm going to build like a real small boat, like an experimental model. So I don't need the F-150 to tow or the Cybertruck to tow. I could actually tow it with a Rivian. Like right now, I'm towing it with like a 2001 Nissan Xterra that's currently broken down and need to fix right now. But I'm just kind of lazy. But at this point, I'm actually leaning towards the F-150 Lightning, and for a couple of different reasons. My wife absolutely detests the design of the Cybertruck. And, she doesn't ask for much in terms of physical things, which is one of the reasons why our marriage works, right? She doesn't bug me to buy things all the time. She, doesn't ask for expensive jewelry. She wants to eat good food, and that's about it. But she doesn't like ever say no to anything. So when I say I wanted to buy her Cybertruck and she like flipped out on that, I was like, all right, I'm going to listen. Because I don't want to sleep on the couch for eternity. But she absolutely hates the design of the Cybertruck. I actually kind of like the design of the Cybertruck, largely because I appreciate the fact that costs were kept down because of its flat panel design and the lack of molding that needs to go into that, and the lack of paint. All of that contributes to bringing down the cost of that base model Cybertruck. So I expect that the F-150 Lightning and the Cybertruck will be relatively the same price by the time I'm ready to purchase, like right around $50,000 for that base model. Probably won't be getting a Rivian. I like the Rivian. Probably won't be getting a Rivian though. The other thing I only need the F-150 Lightning for 2 things. I need it to haul stone so I can add things to my garden in the back. I needed to haul sheets of plywood so I can continue with boat building, and I need to be able to tow a boat. And I'm not going to tow a boat for a couple hundred miles because I can do all the fishing I want right here. So that F-150 Lightning fits the bill. 230 miles of range with that base model, has the basic power pack that I want on there, be able to use it. I'm not going to camp very far away either. And I'm not going to tow for long distances, so I don't worry about the fact that you only have 160 miles of range at best with that base model of towing. So not going to worry about that. And I'm going to leave every day from my house with a full charge because I live in my own house and I have solar. So any electric truck over time for me is going to be a winner. And it's just going to come down to looks for my wife. And I'm probably going to get that F-150 Lightning. But yeah. So yeah. Jason, I would like to know what you use to look at company revenue charts. I use HyperCharts, but they're no longer available. Mostly I use the tools that I have through TD Ameritrade, and they have, you can do plenty. If you have a brokerage, they probably offer you really good tools. You just don't know how to use them. So I have Merrill Lynch accounts, TD Ameritrade. Wait, no, I have Schwab accounts and TD Ameritrade accounts at this point, and they're all going to be Schwab here in just a moment. So I understand that Schwab's system is going to be different They're also going to keep Think or Swim around, which is TD Ameritrade's mobile system for trading. And TD Ameritrade's mobile system for trading is really good for trading options. My options strategy, though, is fairly low energy, meaning if you own a lot of a company that has a pretty high stock price and it has a relatively high degree of volatility, you can sell way the hell out of the money calls on a stock with a delta of like 0.15 or something. There's only about a 15% chance that it's gonna is gonna expire in the money, and you can make quite a bit of money doing that and just reinvest those funds. Where I tend to get burned is when I sell puts. And I do that sometimes to get into a stock where I want, and then sometimes I'll do that and I'll do it on margin. Yeah. Oh, so TD Ameritrade is no longer available to Canadians. The last time I checked. Yeah. So TD Ameritrade and Schwab, I think they merged in 2019. It looks like they're finally getting around first half of next year to merging their platforms, which means that I'm going to have to relearn the platform. I only know Schwab's platform from the institutional side. And I will be honest with you, I don't like Schwab's platform from the institutional side. And what I really hope is that the retail side, which I don't use, has a better user experience than working with them on the institutional side. Their customer service is great, though. Don't get me wrong. Their customer service is great. Anytime I've had an issue, I call them. No big deal. But TD Ameritrade's platform for trading, like on a computer, is fantastic. And I know that's going to change, but you need to embrace change and not fight it. All right. Embrace change and not fight it, guys. By fighting change, that's the way that your portfolio is not going to keep up with changes in the market over time. Also, somebody reminded me, I realized that I have yet to post a picture of my boat, and I will do that. Look, it's not a fancy boat, guys, but I built it with my own two hands. All right. But I will post a picture of that probably on the community page. All right, guys, fire away with those questions. I've only got a few minutes left in terms of what's going on here. Let me see here. One of the big things we're probably going to see, and I imagine we've already seen this. It's probably already gone on in the background. It's just that market conditions have prevented it. We're probably going to see Schwab be a lot more involved on the institutional side when it comes to let me see here. We're going to see have a lot more on the institutional side when it comes to investment banking with Schwab. And that presents some opportunity for revenues there. We have a good question about solar here. You mentioned solar. When I look into it, I wouldn't break even for 20 years. I heard solar sales are plateauing in efficiency. Will ever be viable for the average household? Something like 28% of households in California, that was the last year when I looked at it, already have solar in California. A large part of that has to do with subsidies. So you got the 30%, of course, the 30% tax subsidy that you get for installing, meaning that whatever the cost of your solar project is, if it's $20,000, you get to take 30% of that and use that as a credit against any tax you owe. And even for people of average income who actually don't pay taxes, that if they don't pay taxes, you can still use that as a credit. Against taxes you might owe in the future. So that makes it a little bit more affordable. But even like the total cost of my solar was only $16,000. I wasn't supposed to break even for something like 8 years, but I broke even in like 6.5 because the cost of energy keeps rising. The cost per kilowatt keeps rising. I happen to live in a place where we have a really good electricity grid that's very sensitive. Southern California, not necessarily like the Bay Area, but Southern California has a really good, the whole state has a great electricity grid. We just have more demand than anyone else does. But Southern California in particular, we almost never lose electrical services here, like never. Part of it is when it does happen, it's usually because of fires. But we don't have, we do have lots of high wind events here, but we don't have like tons of lightning and thunderstorms. But whatever calculation you're using, and Nate, I don't know where you live. It may be that your cost per kilowatt hour is significantly lower than where I live. It may be like when I tried to put solar panels on a rental in Texas, I couldn't find a place to do it that cost anything less than twice what I paid here. And I needed about 50% more in terms of solar cells in order to power that house. But there is no net metering agreement with the power companies there, at least where I was trying to put that in. And yeah, so 13 cents in Virginia, that's roughly the same price as here, Nate. Roughly the same price as here. And I broke even in just over 6 years. And it's actually a little bit higher outside of my area, but it's really I'm right next to the border, so we get tons of sun. And we have access to Arizona's grid, California's grid, Mexico, all kinds of different grids here. So electricity is really cheap here in the area that I live in. And I think they may have raised it to 16 cents just in the last couple of months, 16 cents per kilowatt hour. But I don't remember which solar panel system. I don't. It's been 8 years now since we put it on, 8.5 years since we put it on. So I don't remember which one it is. And but the company that I use actually went out of business, so that is a concern for me. But I'm already breaking even at this point, and I installed when I put the system in 130% of my current need, and the company at that point didn't want to let us do that. They were saying there's some state regulation around it, so I basically just said, "Hey, I'm going to buy an electric car." So we went ahead and planned it, but then I did the calculation, and so I've had no electricity bill now for 8 years or so. Since 2014, I've had almost 9 years. So no electricity bill at all. And like I said, it took a little bit less time to break even than I thought. I've had zero issues with it. I've only cleaned the panels once. It doesn't rain here that often. I've only cleaned the panels once. I do get a lot of sunshine, probably in the continental United States. I probably get more sunshine in my area, like really in my band, than most people are going to get, by at least like a solar hour or so. And the issue is that now when I look at how much it would cost to run like a Model 3, 1,000 miles a month, that's about all that I would drive. It would barely fit in there, and I probably still wouldn't have much in the way of a bill. If I had anticipated how many more devices and crap my kids were going to use as they got older. So I will likely need to add another 4 panels to my system, and it's not the cost of the panels that's prohibitive. It's the labor to do that. Okay, and that was my issue with trying to put the panels on that place in Texas. It would cost roughly 100% more to do 50% more work. And a lot of that had to do with where I was looking to put those panels. There were only 2 companies that really had the expertise to do it, that knew they had the expertise to do it. And I'm not saying there's price collusion or anything, but there wasn't enough competition in the area to bring the cost down. So the cost for solar comes down when the incentives align enough to get a lot of healthy competition in there. So Nate, even at 13 cents a kilowatt hour, I'm pretty sure, and granted, I probably use less electricity than you do just because of weather conditions here. I'm only using air conditioning 2.5 months out of the year. So, mid-July to mid-September is pretty much all that I use my AC. You probably use it 7, 8, 9 months out of the year, right? So you would have to put more in the way of solar panels on there. I have been saying that I'm going to upgrade my battery backup for years. I'm probably not going to do that anytime soon, and particularly if I end up getting something like the Ford F-150 Lightning. I don't know if I'll do that, because when I look at energy use, cost, and all that stuff, it doesn't. I want to do it because it's cool. I'd love to have all that storage, but I'm probably not going to do it because it makes financial sense. But yeah, but really, I got the solar panels because simply I wanted to be free from another bill in case something happened in the future to my earnings. Like if I lost my job or something, well, then that's one bill I don't have to worry about, is having an electric bill. And I have no electric bill. I still have a gas bill for heating water and things like that, and for the once or twice a year that we use our heater or something. Yeah, so that's what I figured. And in Virginia, you're using it 7 to 9 months out of the year. That has to be added to the calculation. Like I don't even remember like how many watts my panels are. But I have 12 of them on my roof right now. That was 130%. It would produce about 130% of my annual electricity use. You're going to have to put a lot more on there, a lot more. And if your local power company doesn't have a net metering agreement like they do in a lot of solar friendly states, then it's not going to make any sense for you. And those net metering agreements, the companies didn't do it because it was in their best interest. They did it because the state basically passed a law to force them to do it, and they found a way to make it profitable. So much so now that they're actually worrying that there's so much rooftop solar right now, they don't have a way to manage it, right? So we need a smarter grid to manage all of the rooftop solar that's out there. So last year when I looked this up, 28% of single family homes in California already had solar. And many municipalities have passed laws saying that any new construction has to have solar panels on it. So it adds, the loan was more than the electric bill. So my electric bill was under $100. And the only reason it made sense is because I was planning on adding an electric car and I never did. Right. So it didn't make financial sense if I didn't add an electric car, and I never did. But then the price per kilowatt hour went up, and then it made sense, and now it's paid off. Right. So based on my electricity usage now, if I had to pay for it, it's already paid off. And I've had zero issues with it. I haven't had any equipment fail or anything. What's up, gents? Looks like we're going from inflationary to recession environment. Do our indicators hey man, there's nothing stating that we can't be in an inflationary environment and a recession at the same time. The things are not mutually exclusive. Yeah, I didn't want to go. I didn't want to go into that. So, yeah. So how did the Patreon portfolio go? Actually, it went well at first. We had the Patreon thing. We had people invested in it, and then people really lost interest in it, and I couldn't get them to get on the sort of like Patreon only meetings. And guys, this is where last year I did or 2 years ago, I did an experiment where I let people run like a $20,000 portfolio. And they just kind of made the decisions on what to buy and all that. And one of the guys just got really busy and couldn't attend. Another guy completely dropped off the map, and it didn't respond to attempts to contact. And one of the guys is actually still a member of the Patreon, and we still have active discussions in our group. But so I figured out how to delete that tier too. So if you're going to join my Patreon now, there's only one tier. It's the $5 tier per month. You're really doing it to sort of support the channel and what I do. We do have an active discussion in the Discord chat, and I'm in there at least once or twice a week to answer questions or point out really impactful news. And if I do a trade, I tell them there first, right? But as always, even if I'm doing a trade, it makes sense for me in my personal situation. It might not make sense for you. And the guys in that group, I will say one thing. This is I feel really privileged. I've been in other Patreon groups where the atmosphere can turn poisonous and people have to be kicked out and all that stuff. I haven't had to do that with anyone or anything. It's a really positive group where people share ideas. And we do have a guy in the group now who is a no joke bona fide crypto expert, like works in the industry. And I don't know if he actually wants me promoting him on here, but anyway, if you have questions about that, then he is someone that you should definitely be talking to in that Discord chat. And I tried to get him on to talk about the FTX debacle, and because he's in the industry, it's not something that he wanted to do because he was saying that it was pretty poisonous right now, which I understand why it would be poisonous right now. So, yeah. So it looks like we're going inflationary recession environment. Do indicators change in this environment like the 10-year and the dollar going forward? So we have contradictory signals right now. The last two really big recessions we've had right now, the dollar actually strengthened. And that happened in 2008, and that's happening now, right? We may already be in a recession. We may be seeing I think this quarter, I expect that the economy has actually shrunk a little bit, even though last quarter it grew. I think that this quarter probably shrank again. I think we're going to go through there's a 50-50 chance that we're going to have a shallow recession where we see pretty bold headlines about a recession, but we don't really see deep cut into GDP growth. But we do see some indication of declining corporate profits or depressed corporate profits for a few quarters. And I think there's a 50% shot that it's a little bit more severe than that, where we see 15% or more declines in corporate profits for some of the big guys like the Google, Apple, and that sort of thing. In that case, I would expect it to last a little bit longer. But honestly, this is environment is so corporate balance sheets look so much better going into this than they did in 2008. When you look at the mountains of cash that companies are sitting on, the larger established companies are sitting on, they're in really good condition. Even some of these companies that don't look like they're in the best condition business wise, that look like they actually have a lot on their balance sheet and a lot of runway. And runway is important here, guys. They have a lot of runway to ride out any real bad times. But we are still going to see a lot of companies get shaken out here. A lot of the companies that we really, really liked in 2020 on this channel and liked on 2021, they're not going to survive. They're going to be gone. And it's not because they're not great ideas. It's not because they're not great businesses. It's because they simply will not be able to raise the money from public markets to finance operations anymore because the cost of capital has changed, right? The what I expect to get in return in exchange for giving you this money, you have to add 5% onto that now, right? So if I expected a 10% return, now I expect a 15% return. If I do the multiples on a 15% going forward, what is your market cap now? What do I expect it to be, 5 years from now, 7 years from now for the lifetime of this investment? Can you possibly meet that with what you were telling me your expected revenue growth is going to be? In a lot of cases, that's going to be no. So one of the things you're going to see now is newer, smaller companies are probably going to be revising their revenue projections upward, sort of in the face of a deteriorating economic condition. So, yeah. Yeah, Jay, you're right about the economy. It's so much better to look at previous crash recession. The likelihood the fall won't be as steep. Yeah. I think the fall won't be as steep for really serious investors who are likely to stay invested. But I think that, a lot of Gen Z who really hasn't been through a recession before, they're going to get crushed just like the millennials did. And the lesson it taught them was to stay away from stocks for a very long period of time. So millennials do invest at a higher rate than boomers do. They invest at a higher rate than Gen X did, but at a far less high rate than they did prior to 2008. They were much more likely to be invested prior to 2008. And that scared a lot of people out of the market permanently. Even though this is likely to be a shallower investment because of how concentrated portfolios look for like Gen Z investors right now, I kind of expect that there's going to be a large percentage of them kind of scared out of the market as well. So that's one of the things that I'm not looking forward to, and this is going to hurt them in the long run. But yeah, anyway, guys, it has been an hour. It is just after 2:00. Like I'm limiting myself to like an hour a day on these, partially to save my voice, partially because I don't want to talk so long. You guys all get sick of me. But I'll be back next Tuesday. And I'm going to take a look at some other subjects. And Oog, don't forget to check out the Discord chat through Patreon. And thank you for joining. And I will see you guys next Tuesday.